Well, let's move on to look at the employment report on Friday, what it means for the Fed, and particularly what it means for the markets. Shana Sissel joins us now. She's president and CEO of Banríon Capital Management. So, as one person put it, the jobs report wasn't quite strong enough to convince the doves they're wrong, that the Fed should be done with rate hikes, or was it weak enough to convince the hawks that they're wrong, that more needs to be done? What do you see for the markets in all this?
Well, I think that the job report was mixed, but unemployment fell. It went from 3.6% in June to 3.5% in July, so it's still down. Wages were up 4.4%, and so it's hard to imagine a 2% inflation number when wage inflation is up. And the Fed has been saying that they were looking for a little over 4% unemployment number in the fourth quarter, and that doesn't seem likely based on the numbers that came out last week. So for me, I don't think we've seen the last of the rate hikes. I think that from the market perspective, there's a number of technical signs that suggest there's weakness to come. And so I would just be cautious and defensive, at least at this point. There's not enough here to suggest we have a recession forthcoming. We have mixed economic data, but we have strength in the consumer, the labor market remains tight. And so, there's some negatives and there's some positives. So nothing that says recession, but also nothing that says the Fed should pause.
So let's take a look at the bond market, because we saw the big move up, broke through that double top at, 4.09%. It got up as high as just about 4.35%. That seemed to unsettle stocks on many days. Where is that going to go?
So that is something that should be concerning for equity investors. So the peak of 10-year yields in October, when we saw the market bottom, was 4.35%. Now 10-year yields and bond yields in general are in the 10th decile. Historically, according to Strategas, they've done some great work here. They have 70 years worth of rolling 5-year data. Historically, when yields get into that 10th decile, the S&P performance forward is below average. It's also, if you think about the similarities to what we saw in October, that might suggest that there's downside in the market. Yields rising like this is typically negative for equities. We also are seeing rising volatility that we haven't seen in yields since the 80s. So there's a lot to be concerned about. And these are signals that suggest that there's some hard times coming in equities and there's some weakness in equities. So I would be cautious right now.
So, Shana, does that mean the real bear market bottom is yet to hit us?
Well, that's the debate, right? A lot of people have felt that October 2022 was the bear market bottom, but there are things that typically happen off a bottom that never happened following that. You saw financials broadly underperform. You never saw a rebound in small caps. And now we're kind of back at the same place in terms of yields, which suggests that there's downside in the market. If you look at, say, the Russell 2000, it only recently broke out of 17 straight months of rolling 12-month negative performance. And typically that can be a good sign. So I'd be watching small caps right now to see if there is any sort of breakout. But we're also seeing changing in leadership to energy and materials, industrials away from technology and consumer discretionary. That's indicative of maybe a change here in the way that the market is trending, and not in necessarily a positive way. It's really hard to imagine a scenario where we see continuing earnings growth and strong earnings growth when you have rising rates, inflation, and weakness in the economy in places like manufacturing. The ISM non-manufacturing was weak. So there's things that have me concerned, but nothing that screams recession right now.
Nothing that screams recession, but it's interesting because, we talk about that the consumer is still resilient, that household spending is still pretty okay. But at the same time, you look at these specifics, like you point out, back to school spending, for example, reports showing that we could see that decline for the first time in about a decade. And they're not insubstantial declines either.
No, there's that. We've seen rising consumer defaults, but also nothing overly concerning. We saw in November 2021, we had an all-time low, according to the S&P Experian Consumer Default Composite Index. And we've risen from there. The low was like 0.37%, and it's risen to about 0.72%, but the long-term historical average is over 1.5%. So we're nowhere near default rates that are concerning, but they are rising. So that is something to be of concern. There's no fiscal stimulus in the system. There's clearly a desire to pull liquidity from the system. None of those things are positive for equities or earnings. They are absolutely headwinds to those things and to the economy. And in some of the leading indicators, you definitely see weakness. So there's reason for concern. And like I said, nothing that screams, recession now, but definitely things that suggest that this idea that we're not going to have a recession at all is probably not true.
Okay.
I could see that in early 2024.
All right, and you're not alone. Shana, so what do I do with my money? Do I move over into cash? Do I just, find the defensive stocks? How do I handle this? At least until early next year, if there's going to be a recession or not?
Well, a lot of people go into cash right now. We've seen record flows into retail money market accounts, and the average money market account is yielding 3.94%. So, there's something to be said for that. I am looking at sectors and stocks and positioning that will benefit from rising correlations between equity and fixed income, which tends to happen when rates are rising. So I like my liquid alternatives. I like my MRSK. I like my BTAL. I like my FMF. Those are 3 ETFs I really like. As terms of stock ideas and sectors, I like sectors that will benefit from scenarios where there's less liquidity in the system. So those are things like energy, materials, healthcare, industrials, and some of my favorite names fall into those categories. Southern Copper Company is one that I've talked about a lot. It was up 15% in the last month. It has good momentum. Its market multiple is in line with average, and there's a lot of tailwinds to their business in terms of the macro. You look at a company like Caterpillar. Caterpillar has a lot of correlation to rising rates. It tends to outperform, trading at like a 12 multiple. The market's at about 22. Really good financials, very stable business, great management. So that's another company that I really like. And then in healthcare, you have something like Cigna. That's a company that obviously has been growing membership. It's been making acquisitions, great capital allocation strategy, trading at a very low multiple, but have had growing earnings for the last 12 months. So it's something worth considering. But those are the names I'm looking at, things that will benefit from liquidity being removed from the system, as opposed to, say, those growth names, those tech names that tend to do better when there's more liquidity in the system and when rates are lower.
Shana, always great to chat with you. Shana Sissel, President and CEO of Banríon Capital Management. Let's take a look at